don't be quick to throw your money into just anybody's deal. Go to one of their properties, meet them in person in their market where the property is.
What's going on, guys? Welcome to the Creating Wealth Podcast, where I, Kyle, from Kyle Curtin Real Estate, interview local top dogs in the real estate investing, wealth building, and personal finance industries. Let's build together. What's up, guys? Welcome to episode 113 of the Creating Wealth Podcast. Today, we have the great pleasure of chatting with Fjord. Lee has had quite the journey from buying a two-family in 2017 to becoming the lead asset manager of Green Forest Capital. They have purchased 577 units so far, with another 100 plus units under contract. Lee, super excited to talk to you, man. Welcome, and let's jump in. How are you?
Kyle, doing great. Thanks for having me on. I am really excited to get to know you and be able to provide some value to your audience. And I love helping as much as I can.
Thank you, man. I definitely feel you there. So, let's kind of jump in, like how did you kind of catch the real estate bug and, start to kind of get into like the investing portion and take us back to the origins.
Yeah. So 2012, I had just before that, 2011, during the recession, I had a failed business. I had a retail business that failed. It was a very successful business that a larger corporation decided didn't need to exist anymore within its greater, portfolio of small business partners. So they essentially did not renew our contract on the company and realized, okay, I'm not in control of my own destiny, even as a business owner. Didn't realize the small print meant that a giant publicly traded multinational corporation with franchises could just decide to shut you down by not renewing your contract. So I had to make some big choices, and I was like, what am I going to do? And I went and got my real estate license because I thought that I was going to be the, millionaire real estate agent selling houses and, driving around in a BMW. So I sat open houses for 6 months, twiddling my thumbs, waiting for somebody to walk in. Needless to say, that never happened. My broker came to me and she said, hey, we've got 20 houses under management. The guy who's running them is leaving. Do you want to take them over and go into management? And I said, sure. So that was my first kind of real foray into it. And then built that up to over 200 single family houses and small multis and condos under management in 4 years. Realized that the guys who were making all of the money were the owners of the property. And started listening to podcasts and getting educated, surrounding myself with people like you, and learning and growing, and then decided to take the plunge and bought my first duplex in 2017. And there were a lot of mistakes that were made with that project and the ones that followed there, but you just get better every single time.
Absolutely, man. I love that. And it's funny too, like how often like people kind of have beginnings like that, right? Where like, they work in, some of the fields, maybe like in insurance or, in other parts that are loosely connected to like the investing space in particular, or like, people that work at the bank or like, CPAs or something like that start to see what real estate investing looks like from a different side of the coin. And like, oh crap, like this guy's doing pretty okay. Like he's doing something right, and it's really wild stuff, and I love hearing it, man. It's awesome. You know what I mean? And it's just, even there was a guest that I had on a couple weeks ago. His podcast came out. His name was Ryan Corcoran, and he was going to school to become a physician's assistant. And then like he started to find real estate, and he's like, crap, like, I'm getting paid potentially the same amount from acquiring, stabilizing, and dispo in a multi than I would for, a year at my PA job or whatever. And like, it was just that paradigm shift of like, wow, like there's a decision that I could make here, and like, what does this mean? Like, there's something else you know, and it's cool stuff, you know, and yeah, absolutely.
It really is. You know, once you get the bug, and especially after you've done one or two investments and you start seeing those, you know, those small chunks of money hit your bank account every single month, it's eye-opening. And then you just want to do as many of them as you possibly can. And these days, I try to focus my time and attention on helping others avoid the mistakes that I made in the very beginning stages. So that's kind of where I'm, you know, focusing my time and attention now, is to help others avoid the pitfalls of being a landlord. You know, that is that's not passive. That is not easy. That is not fun. It is just buying yourself another job. And most people who have a career, you know, and they're not like on the precipice of a choice, you know, like they're established, they have their life figured out, they've got their kids and their wife and their dog and their white picket fence, and they got bills to pay. We can't just leave it all behind and be like, I'm going to go buy a duplex.
Yeah, no, I definitely feel that, man. I have a 3-family closer to Central Ma, and just the one property that I have at the moment. But yeah, no, the lessons and experiences and, you know, value of time being introduced versus delegation, and like all these different like crazy business lessons like really get introduced. Like you said, even in like that first property, second property, like it's different, you know, like, because yeah, I mean, I wouldn't trade it for the world, you know what I mean? But it definitely is not exactly the mailbox money that, you know, a lot of people like to talk about. It's a lot more active kind of management, you know, depending on how you structure it. But
it is just like what you said. It's all about how you structure it and how you approach it. You know, you can buy yourself another job, a side gig, or a nighttime or weekend type job, or you can actually be an investor. It's one of two things. You can make the conscious choice to do one or the other, or in a lot of cases, I work with people who do both. They have, you know, some of their active investments, and then they've realized that if they incorporate in a passive portion of their overall all-arching investment strategy, it really helps even out the amount of returns and effort and work that it takes in order to create, you know, financial freedom. You know, that's the name of the game. That's what everybody is goaling towards, is this financial freedom thing. That is, quite honestly, if you're just going around buying a bunch of duplexes and 4 families and single family houses, you're not free. You're just bought yourself a job. You just have a different job. Now you're officially a property manager. Congratulations. You're a property manager who has no clients but yourself. Like, that's it. That's all you are, you know.
Exactly.
Which is fine for some, but that's not financial freedom. Financial freedom is being able to be in, you know, Switzerland skiing the Swiss Alps and have your quarterly paycheck hit your bank account, and then at the end of the year you get a K1. That's financial freedom. Yeah.
Oh, totally. And it's funny you say that, man, because I've started to, you know, kind of jump into that world a lot more, you know, more into like the or I'm very early to the process of it, but kind of like the concepts and like the pros behind like alternative investing and like, you know, raising capital for projects and like different things and like the benefits and all that kind of stuff. And it's extremely eye-opening, man. And like, even there's a lot of different angles that, you know, have been kind of on my mind and stuff that we could kind of take, you know, but like, even one of the things to keep in mind too, I mean, is definitely the time factor of like, you know, do you want to be the guy that's, you know, running across town to these 5 properties and like, you know, trying to get things going and like just being a firefighter basically, you know, and like people do it all the time, you know what I mean? And it's like, there's definitely like, you know, pros and cons to everything, but me personally, like down the road, like I don't, you know, want to really be that guy that's self-managing like 10 plus buildings, you know what I mean? Like, I don't know, but I mean, and also on the other side of the coin, right? Like, especially with another concept that kind of got brought to my attention in this kind of space is like, say you're looking for, you know, so you have like maybe a 3-family or a couple buildings, you're self-managing, like returns are looking pretty good. I mean, and like you're still using, you know, conventional financing or like a DSCR loan or something like that, you know, you're looking for like maybe another couple, like just to keep buying them as time goes on and stuff. Great plan. But also one thing that is interesting is like, you know, where the interest rates are right now and like how that plays into like your cash on cash return and like the supply. Like it's definitely, I feel like there's definitely kind of a paradigm between like, you know, the lack of supply and like just where the interest rates are and like, you know, like, oh, if a deal comes up, like 1.5 million people are going to look at it, but also like those you might have to be okay with the smaller cash on cash, you know, because of like just how much how much more expensive the debt is versus like a year ago, you know, and like I feel like it just kind of makes the pool a little bit harder. But if you were to, you know, potentially invest and partner up with some other people on, you know, JVs or like buy shares of syndications and stuff like that. I mean, what if you could be able to get like a double-digit return and, you know, have someone else and their team be able to structure like the project and run everything, stabilize everything, and you know, you get to retain your time plus potentially a higher benefit than trying to do it yourself. You know, it's something that's been going on in my head and very, very interesting.
That's exactly the thing to focus on. And the one key word in what you just said is time.
Yes.
Time is the one thing, once you spend it, you can't get it back and you can't earn it again, ever again. No matter what, it's gone. That's it. And if you are, I call him Frank. Frank, it owns about 20 to 40 apartments or single family houses around town in his own backyard. Frank is retired or now financially free. Frank spends his days going from unit to unit, property to property, driving around in a rusty pickup truck with a weed whacker in the back, knocking on doors, collecting rents, showing apartments to tenants, prospective tenants. He is pulling leaves out of the gutters. He's weed whacking the sidewalks. He is collecting his rents in sweaty $20 bills every single month from 20% of his tenants. And then his wife is doing the bookkeeping and the accounting at night. And she's doing it in a very poor manner usually because she's not an accountant. But she does her best, right? So Frank spends his nights and his weekends and his daytimes, you know, running around town, painting walls and everything to do that, to be essentially a property manager. Frank is not financially free. Frank cannot go on a 2-month-long vacation to Europe without getting any phone calls or without having his portfolio potentially going to, you know, very high vacancy levels or anything. If the grass grows tall enough, guess what? He's going to get a call from the city and they're going to foreclose on his property. And then he's not going to collect his rent because he wasn't there to collect those $20 bills in person from, you know, his tenant base. So there's Frank. Frank is not financially free, but Frank probably has about $1 million worth of equity tied up in his portfolio. You know, if he owns those properties for cash, he probably has $1 million. And this is Frank's version of retirement. And he is a millionaire. He is the millionaire next door. Yeah. But is he financially free? No. He's tied to a small business that is basically just him being a property manager for himself. Now, then there's the person in the middle. Then there's the person who has a real company, who buys large enough scalable assets, who comes in and they actually asset manage the project. They spend, you know, time focused on acquiring properties, asset managing, partnering with other people, bringing in their money, partnering with professional management companies, which, by the way, Frank can't do because Frank will go broke on all of the management expenses that small time property management company is, you know, earning for replacing Frank. So Frank tried to replace himself. He'd lose over half of his profits. And now he's not profitable at all. And now he still can't go to Switzerland, you know, at all. So then there's the middle person. And there's Lee. Lee's in the middle right now. Lee is the asset manager. He has a real company. There's hundreds of doors. I can afford to hire third-party property management companies to run all my deals and do a great job. And I am the driver of the bus or the buggy driver. You know, picking which horse to whip. determining when to pull the brakes, steering, making sure that the people in the back are safe and happy and that the Indians behind us can't hit us too hard with the arrows, right? We're going as fast as we can.
Yeah.
So then there's the third phase, the third investor. The third investor, I call him Joe. Joe, he is passive investor. He has, in many cases, he used to be Frank and he sold his portfolio. You got to sell to scale in many cases. I did the same thing in order to reach my middle ground, but you can skip me and move on to the next level. You sell your portfolio, you realize those $1 million worth of equity, and you put it into a passive investment still in real estate to be able to take advantage of depreciation, appreciation, ability to scale, the ability to force appreciation on the property, create monthly cash flow that comes in. In many cases, it's, equal to what Frank was already earning. And then, Joe gets his quarterly distribution of cash flows on time. He relies on a professional asset management company to be able to run the projects that he's chosen to invest his hard-earned money into. He can properly diversify his $1 million into multiple projects. So he can pepper his 50 grand into 20 deals. Yes. So then what happens when one of them goes bad? It's okay. Diversification. That's the beauty of it. You put it with one guy and it doesn't do so well. You do it with another and it does fantastically well. You can also do it with cash flow. Some deals cash flow better and worse than others. Like you put your money into a deal that is focused purely on appreciation in a high growth market like Tampa, right? Put 50 into that. And then you do 50 into a high cash flow market like St. Louis, where we can distribute out 10% cash on cash returns, but the appreciation might not necessarily always be as well. So you can create a diversified portfolio of real estate investments by putting your money in passively with other people in their deals. So it's your choice, depending on where you are. I feel like I've gone on and kind of like a tirade now, but don't be Frank. If you're still working hard and you want to be a full-time real estate person and be actively involved in the deal and so on and so forth, my suggestion is to be a Lee. And Lee isn't just apartments. It can be any asset class type you want, whatever. And I used to be Frank and I sold most of my properties and I put all of that money into my deals. Yep. My objective is to be Joe. I want to be Joe one day. I want to just be purely passive because there's nothing better than when I see my distributions come from my deals or the deals that I've invested in with other people and they just hit every quarter. And I'm like, oh, that was nice.
Perfect.
Didn't have to go and make sure the rents got collected. Didn't have to drive around town on a rusty pickup truck. Didn't have to attend. I attended one meeting. For half an hour. I read a couple of emails like, oh, great. Looks like the property's doing good. Sounds good. All right. And I got a fat depreciation check against my income to reduce my taxable income. And it was beautiful. A lot of people don't realize you can diversify and you can choose to be a little bit of everybody if you want. I still have a little bit of Frank in me. I still have 24 doors that I manage myself. And but I could still just be Frank. Instead, now I'm Lee and I'm a little bit of Joe. So I'm like transitioning from Frank into Lee, and then eventually I'm gonna be Joe. But I have a little bit of all of them still. And eventually I'm gonna sell all my portfolio that I have small stuff and get it all put into Joe. I'm moving from Frank to Joe. So
I love the way you described it.
That was fun.
No, that's okay. That was phenomenal. Seriously. Like I absolutely love the way that you described that, especially with kind of like the different options, because I feel like generally speaking, like a lot of people don't know that there's more options to invest in real estate besides just like buying a 2-family and painting the walls yourself, and it's a game changer, and I mean, exactly. Like there's a story from, there's a local operator up in Wakefield, Mass, up where I am. And he told a story at an event one time of he had a buddy that I'm pretty sure he played like a ton of poker. I think that's what it was. And like he ended up, in like this tournament, and I might be butchering part of the story, but the concept is still gonna, kind of work out. But he had this buddy who was playing poker. He played in a tournament. He got like an $800,000 payout or like over $1 million or something like that. And he ended up going to this operator who's been in the game for a very long time, you know, done syndications, done ground up development, like more wholesales flips than you can count. And he asked him, he's like, oh, you know, Tommy, like, how can I invest some of this money? And he told him, you know, about like the syndication type of model and like what, you know, forecasted returns looked like and the years and when the payout, like when the distributions would be. And he ended up doing that. So now, you know, the cash flow that comes in, you know, whether it's monthly, quarterly, whatever their deal is, on that 800K pays for his lifestyle for like everything else in his life, you know, and he's like living comfortably and literally like just from doing that. And the beauty of it too, that is becoming more, I'm discovering more of, you know, as I keep exactly like having conversations like this or like reading books, listening to podcasts, that type of thing, is like theoretically it's such a win-win for everybody, right? Because like his friend is able to like literally essentially just get this money in his mailbox every month and like, you know, make a pretty handsome return on, you know, some of this money that he acquired. The operator is also able to, you know, have money to be able to play with and put into deals and be able to do more deals. And yeah, you know, it's a really beautiful thing. And it's been a lot of fun to kind of learn about this side of the industry. And I'm excited to really like keep learning more, you know, because like that's what I was thinking about it. I'm like, oh, you know, the operator is able to do more deals because he has, you know, more funding, you know, for that type of thing. And then the LP has, you know, basically, you know, gets a pretty decent return, doesn't have a ton besides, like you mentioned, you know, like checking in or getting updates, like whatever that structure looks like.
Yep. It's
you
very
know, and
easy. With a portal, you just log in and you look at how much your distributions were.
Yep. Is it Invest Next by any chance?
I use InvestNext. I just switched
Nice.
over to a company called Cashflow Portal.
Yep.
I've used all of them. I've used Syndication Pro. I've used InvestNext. And now I'm switching to, on my next deal, we'll be using Cashflow Portal. And eventually I'll have all three. And then I'll dispose of the other ones and I'll focus only on one. So like it's like driving three different cars. So it's like, it's something I like. Yeah.
I feel you there, man. I one of the operators I've been working with up here, he introduced me to InvestNext, and I like just signed up for it recently, more for like the capital raising kind of stuff. And it's such a cool platform. I like it a lot. You know what I mean? And like I have to like dig a lot more into it. You know what I mean? But I mean, exactly, like just to be able to have a dashboard for like to come in and check how things are doing, and like, you know, maybe like different projects from different people could be in there, and it's cool stuff. Plus it looks really sharp, and I'm sure all of them look, you know, really sharp as well. But it's cool stuff.
Yeah, the advancements of technology in the last, let's call it 10 years in the real estate industry has changed the game. It's given anybody the ability to choose to do this. 20 years ago, you had to like join the country club and know some guy, and it was all behind closed doors, and it felt kind of sleazy, but you knew him really well, but he was a little bit of an alcoholic, you know, like you know, like his wife was a little too out there, but we were at the country club and he has this great deal, so I'm going to put some money in with him. These days, everything is completely different. The advancements of technology, the ability to be able to do this, like an investor to invest with, you know, whether it be their personal funds or their self-directed IRA, or, you know, you can actually borrow against your 401k. You can borrow up to $50,000 against it, and then deploy that money. So let's say it costs you, I don't know, I think it's something like SOFR, so it's about 4%. So it costs you 4% to borrow the money against it. But if you earn, our average annual return on a deal really was 20%. So you make the spread on that 50 grand. And
hell yeah.
You know what, you know, reverting just quickly back to the guy who won the big payday, $800,000 invested it. So one thing to take into consideration, in addition to him having the cash flow to pay for his lifestyle, while that money is inside of that investment, it is continuing to appreciate. The property's paying down its principal balance on his mortgage. It is, you know, they're improving the efficiency of the property ideally. and eventually there's going to be an exit there. And when they exit, his money will drastically increase. It will, through the proceeds of the sale of the property. So not only is he getting, I don't know if it's it's 800,000 times, we do an 8% preferred return. That's our preferred return on every single one of the deals that I've ever done. So times 0.08, he's earning $64,000 a year pre-tax. And by the way, let's also talk about depreciation, which is a beautiful thing. That really helps consult your tax accountant, but it really would decrease the amount of taxable income on that 64 grand. So he's making 64 grand a year off of it. Well, in addition to that, our business model involves essentially increasing your capital on appreciation only, just appreciation. You take the cash, you spend it on Lambos and trips with your wife and live off of it and all the things. Well, after that, there's an additional something along the lines of 8% annually that property increases in value. Your assets increase in value about 8% on top of that. So that essentially is about a 60% increase over a 5-year hold period. So if you take 800,000 and you multiply it by 0.1 or delete 1.6 now turns it into 1.28 million in 5 years. So he's lived off of that 64 grand, right?
Yep.
You sell the property. Let's call him Ed. Ed now has 1.28 million to invest into the next deal. Now, how much does Ed make off of that every year? So that times 0.08. Now he's making $102,000 a year. This is from year 5 to year 10.
Yep.
Okay. So $102,000 per year. So now his 2 turns into times 1.6. 5 years later, he's had his money invested for 10 years. How much is it worth? 1.9 million.
It's crazy.
Now, how much cash flow is he making from year 10 to year 15? Like, you can keep doing the math, but now he's making every year on that money $153,000. He's got 1.9 million in equity. He's more than doubled his 800,000 over 10 years, more than doubled, and he's been living off the money. Just think about that. He's been still living off of the cash flows, off of the money that's distributed.
It's mind-blowing. It's nuts.
It's insane. That 1.9, man, we just have to go one more time. We got just for fun. You've had the investment for 15 years. How much do you think it's worth now?
Ooh, I'm not sure.
3 million. So 15 years from now, you can take this number and you can remove a 0 and start with 80 grand.
Yep.
80 grand turns into 300. Just remove a 0.
Yeah.
I know a lot of people who have 80 grand or 50. Yep. Our minimum is 50 on our deals.
Yeah.
So it's just the velocity of the capital. And every time you hit the reset button and you sell the deal, which a lot of people are like, lifetime hold, pay it off, equity, just keep it forever. Well, when you recycle your money into another project, you get a higher amount of cash flow on the money that you've deployed into the deal. Your appreciation escalates as well, and it's just like a ticking, growing, snowball. It's a snowball that just continues to build upon itself, and you're still, by the way, living off the cash flows still. So
exactly,
that is the difference between being Frank and being Joe. Do you want to be Frank, who owns 40 houses, cash free, debt free, and he's financially free, and his wife's doing the books, and he's driving around town in a rusty pickup truck with a weed whacker in the back, and he's painting walls, and he's collecting rents and sweaty $20 bills that smell like cigarettes? Or do you want to be Joe? You could be either one. 15 years from now, I bet you those houses aren't worth 3 times as much as what you bought them for 15 years from now. Just saying.
Yeah.
So That's what I try to do. I try to educate people now on the difference of being Frank and being Joe. And then I also educate them on who I am, who's Lee, what do I do, what value do I provide? How do I make sure that Frank, when he becomes Joe, doesn't become broke again or destitute or whatever, Make sure that the investment is successful, provide the highest level possible returns. I am better at my business than Frank. I can tell you that. I guarantee you I'm better than Frank at his business. I could take over Frank's 40-unit portfolio and run it twice as well as he would. I'd fire his wife doing the books. He'd be done. That's it. Becky, get in the back. You're not doing this anymore. I'm calling, Abel. And Abel is an accountant. And he's going to be doing the books from now on. And we're going to bring in software systems. And we're going to automate things. And we're going to, hire a professional maintenance company to be able to do the maintenance. Because that's the one thing that nobody should be doing if they are a millionaire is fixing toilets.
Yep.
I know because I do it. I used to do it. And I do it as little as I can. I have a very efficient management process for our, smaller portfolio. But that's the difference. So don't be Frank. If you don't want to do it full-time as your full-time job and you aren't as skilled and don't have, a decade of experience in the industry, probably don't be Lee. Be Joe. Even if you only got 80 grand will turn into 300 in 15 years.
Yep.
So.
It's nuts. Yeah. I mean, even you, man, I got a little bit of experience with investing on the passive side recently, like while, kind of getting into this stuff as well. So I bought my 3-family in December of 2021, and through just like value add and appreciation and stuff like that, it appreciated a pretty fair amount. And I was able to take a home equity line out of it. Given the interest rate was a bit higher on it than I, was expecting, but, I was able to take like well over 5 figures for that and be able to experience, like the LP, like more passive side of the industry, while learning like this kind of side at the same time. You know what I mean? It's incredibly interesting. And to a point that you made earlier, I mean, there's a lot of different ways to be able to like just find this money, right? I mean, especially like with just the general overall appreciation in the markets over the past couple of years, like 2020, 2021, especially, like people were paying stupid amounts over asking, like crazy, and like, I mean, I was able to pull that out of my property in 13 months. It still kind of shocks me that like, I don't know, like how equity works, and like I'm like, phew, like this stuff's cool. But like my point being is like, like my parents' house have had their house for well over 20 years. I know that there's a pretty wide spread in there, and like, I mean, even like the perspective in my mind has changed a little bit. Even like looking down the street that I grew up on, right? I'm like, oh, these neighbors have been here since I was growing up. You know what I mean? Like, just think about like all the equity and like, who knows, like maybe they're looking for something that's a little bit different. They want to grow this money, but they don't have time. Like maybe they're, about to go into retirement, or, they don't want to like, maybe like the properties are getting a lot for them, like work wise, like, people are getting older, yada, yada, yada. But I mean, even also, like you mentioned, man, was like, 401k, like I'm already looking at my 401k equivalent from work thinking like, man, like how do I draw from this thing? Like,
but you don't have to draw. You don't have to draw. You don't have to realize the penalty. You don't have to sell anything. You can borrow up to $50,000 against it.
Yeah, exactly. And it's crazy stuff. Like there's so many ways to be able to do it. Like you don't necessarily have to have 50, 100K in cash in your bank account. It could be literally in the thing that like we're sitting inside right now, and like, who knows, maybe like, the rates are more favorable. Maybe like a cash out refinance is something that could be in your future, get a payout from that. Maybe taking a home equity line, and, maybe the spread's still reasonable for, investing passively and making a pretty reasonable return like that, versus beating the spread on, the expense for using that money. Maybe like I don't know, like there's so many different ways to skin the cat, and it's a really, really beautiful thing, you know, and I feel like just a lot of people don't know, you know, and it's cool.
You got your walking shoes on and ready to go knock doors up and down that street?
Yeah.
You probably have a lot of equity in your home. How do you like to turn that into a monthly paycheck that comes in and you don't have to do any work? They slam the door in your face and think that you're some sleazy salesman trying to sell them knives or something.
Like Cutco knives or something. Yeah.
Hi. Did you realize you probably have 6 figures in equity tied in your home right now? You can turn that into cash money in your pocket every month.
Exactly, you know, and like, I mean, even for because I've been listening to podcasts up and down, man, you know, like just trying to like really focus what I'm absorbing, like to niche down into this kind of stuff, right? And even like from the angle of one of the things that there's a podcast I've been loving. It's I think it's called the Raisin Private Capital Show. It's on like Apple Podcasts, stuff like that. This guy named Yakov Smart, and I've been absolutely gobbling it up, right? And like one of the things that he was mentioning too was even from like a different, looking at like these kind of investments from a different angle, right? Like say you have like, you know, a bunch of buildings and stuff like that, like to invest passively, you know, from a I'm trying to remember the word or the phrase rather, basically more of like a protection standpoint, like to, you know, like just like basically put this money somewhere and like, you know, have it growing and stuff like that. And like, I mean, obviously like, you know, wanting to make a solid return on it and stuff like that, but more to like actually protect your principal rather than, you know, trying to make like the biggest return out there, you know, like depending on the side of the coin that you're looking at. And it was really eye-opening, you know what I mean? Like,
your risk-adjusted rate of return and being able, not having control, true daily control of your money is usually a good thing because fear and emotional decisions will affect how you choose to manipulate your investments in your portfolio. And next thing you know, where somebody's doing this and it's all over the news and you're like, sell everything, and you sell at the bottom. If you have it tied into a real asset, a fixed, actual real asset that you don't necessarily have control over, is probably a good thing, especially if you're okay with, most people, they'll go and they'll just spend it. People who win the lottery, they're broke 5 years later. If you put it all into a syndication or a deal, or multiple syndications, and you don't touch your principal ever, that principal continues to grow while you're collecting your distributions, and you can live off of that money without having to go and be like, what I really want is I want a yacht. I got $2 million in equity, or $1 million. I'm Frank. I want a yacht. And then next thing you know, you're broke and you're back to painting houses again.
Yeah, exactly. I do want to ask you, Lee, because I've been curious. So what are some tips for the audience for, discovering like operators and like, I guess kind of like vetting deals and stuff like that? Like, they, like you said, like, they know maybe somebody in their network that is doing these kind of deals regularly, and they're like, maybe wanting to learn a little bit more.
Yep.
I guess where can people usually go? Like, I know social media is a huge freaking tool right now, and for the past X amount of years, but I mean, like, how can people go about like learning more about this type of investing? Like, kind of vetting operators, vetting deals, like seeing if it's a good fit type of thing.
I would say it's a happy medium between, someone and trust, and also someone who is a reliable and a person who has a successful track record as well. So who do you trust and know and love the most? Your family or your best friend or your neighbor. Don't do business with them. That you trust them, they trust you too much, and it could end up impacting your personal relationship with them. And my suggestion would be, like, if your best friend is a house flipper and he's asking, or you're thinking about giving him $100,000 of your money to go and deploy it into his house flipping business, don't do it. No, you will. I mean, regardless of even if it's a trusted person, he's good for the money and all the things, there's a good chance that your relationship will be negatively impacted at some point during that time frame.
Gotcha.
But also not a perfect stranger either, not somebody you haven't done the research into, not somebody that you can't, have a call with, just like throwing it in with whoever's, paying the most for Facebook ads, like not that guy, not the guy where you're going to be just a number on a spreadsheet where you're like, yeah, that's just some guy. I've never met him. I don't even know. Like my bookkeeper makes sure the distributions go out, like they don't know my number. If they called me, I would ignore their call. I'm too fancy and I'm too big riding around on my plane, no. Don't put your money with that guy either. There's a good chance that he doesn't care about you. He doesn't know who you are. He doesn't treat all of that. So there's that kind of middle ground. So you asked me for a suggestion of how to do it. That's what I didn't go that direction. I would say go to one of the big publicly marketed conferences with the objective of meeting 3 to 5 syndicators or investors, sitting down with them in person or meeting them in like a networking room or whatever and be like, hi, my name is Frank. I got $1 million. I just sold my portfolio. I'm looking to invest it passively with multiple syndicators and multiple deals in multiple geographic locations around the country. Tell me about yourself. Nice to meet you. Shake your hand. How are you doing? You're a real human. You're not, an AI bot. So, that would be my suggestion. Is there are dozens of conferences every single year. Don't do it at a real estate investment group. I mean, most of those are so sleazy, and most of those people are only out for themselves. Some wholesaler who needs hard money closing. It's just so sleazy. Like, you're taking advantage of a little old lady sitting at their dining room table, man. I'm not going to give you my money. You're just going to run out and go buy a Lambo with it. So, like, it's the happy medium, the person who has had some sort of success, and then vet them. And don't be quick to throw your money into just anybody's deal, Go to one of their properties, meet them in person in their market where the property is. If they say, no, I'm not willing to meet you, if you, the investor, are willing to fly to St. Louis and, spend the night and come to St. Louis, I will sit down and I will have an hour and a half long coffee with you. I will take you to one of my properties. I will show you the good and the bad and the ugly about that property. There are ugly things about every property,
Yes, definitely.
Like, what's that? Oh, that's the neighbor that is a storage facility that runs a flea market out of it. Like, we have a property like that, and it's a very, very great property, but they're like, what is that ugly thing right next door? And it's like, oh, that's the flea market.
It is what it is.
Yeah. No, it's real estate. It's investment. Like, but it's also, so that is what you should hopefully look for, is someone who's willing to give you the time before you give them their money,
Gotcha.
Like they're going to qualify you too. They're probably going to want to know, like, if you're real, if you actually have any money at all, and you don't waste everybody's time, because time is one thing you can't ever get back. So go to a conference, find multiple people that have a track record of success, research them, ask them questions, meet them in person, ideally also at one of their assets that they've already owned for a little while to make sure they actually have done it before. And then come in slow. Put in 50, the minimum, and test them out. Make sure their communication with their investors is up to par. Too many people in this industry collect money from investors, and then they aren't as communicative as you would want them to be, or whatever the case may be. And you're going to have good syndicators and bad syndicators, people that care about you, people who don't care about you, people who invest in the market that you want to be in, and people who invest in places that you should be investing in. But yeah, take some time, find a conference or two, go to the conferences, set a goal, meet 5 syndicators, follow up with them, pick the 2 you like the most, go visit them in their market, meet their family and their wives, and see one of the properties that they put through the cycle on, and then ask for access to their investor portal, ask for the most recent, distributions of communication that they've sent out to their investors prior, ask them for even referrals to other investors that they've had before.
Yep.
Don't put your money in for, into a deal with his first time. If this is somebody's first time, like, I better really like you. And thankfully I had those partners and investors who really did like me and invested with me years ago. And I used that to build up. So that's, conferences, meet people, know them in person. Don't be a number, and don't invest with your friends or family, and don't do it at a real estate investor meetup group.
No, that's awesome advice, man. 100%. Like that's like golden. You know what I mean? And that's awesome. And it's funny you say that about the conferences too. I've seen there is one, I've seen a couple actually, like just on, social media and stuff like that I'll probably look more into. There was the Rod Khleif, I think, has got a multifamily one.
Yep.
I believe.
Yep. I'll be there. I'll be at that
nice.
conference in, I think it's in July. Rod does usually 2 a year. I go to them. I'm actually one of the Rod Khleif coaches. I'm a part of his education program, have been for many years. It's funny you mentioned Rod, but like you go to one of his events and you will find guys like myself who have a track record of success. You get to meet them in person. Another good one is the Jake and Gino event. Jake and Gino does multifamily mastery. I think it's once or twice a year. I'm also part of their group as well, and it's a great education platform group. And you don't necessarily need to go with the thought of like, I'm going to join a group and become an active investor, syndicator. I'm going to go to that event to go meet, potential syndicators where I can deploy my money into. And there's at every one of those events, there's other people there just like them that are doing that. So
that's awesome.
That's what I would suggest. Rod, you went there, I didn't, but Rod Khleif conferences, it's worth the ticket price all day long, 100%. And the same thing for the Jake and Gino and multifamily mastery conferences.
That's awesome, man. I'm definitely gonna have to dig more into those.
Yeah, they're worth it. You should absolutely, if you can. That'd be great.
Yeah,
I'd love to meet you when you're there.
Absolutely. So, Lee, I do have one question for you that I like to ask everybody, and that is, how do you define wealth?
Freedom, time and geographical location freedom. That is my objective. I want to eventually be Joe. I want to be able to live anywhere in the world for long periods of time, and still maintain my healthy lifestyle, and mindset, and but also income, so time, not having to be in a glass cage, and also not having to be chained to a particular geographic location. So I want to be able to travel with my friends and my family and enjoy the world. The world's a very small and beautiful place, and if you've never, that's my objective, is to be able to go and be skydiving in Switzerland and then open up my phone and look and be like, oh, I've got my distribution this quarter. Yay.
I love it, man. Absolutely. I love that so much. Oh, sweet. I do have one more question for you, actually. Yeah. The question is, do you read, and what is your favorite business, investing, or real estate book that you would recommend to anyone? It could be like a podcast or like anything you consume and
I do read. My favorite book is this book. I have it right here, Think and Grow Rich. I reread it at least once or twice a year. I'm currently reading, it's not sitting here on my desk. I have another one right here. This is another book that I usually read a couple times a year, Rich Dad, Poor Dad. And then I have, right now I'm reading Own Your Mind, I think is what it's called. It's another Napoleon Hill book. I mean, it's a fantastic, there's a series of books that they released recently from Napoleon Hill. I highly recommend it. And then, from a podcast aspect, I definitely recommend the Lifetime Cash Flow Through Real Estate Investing podcast with Rod Cleef. The Wheelbarrow Profits podcast, or I think it's just called the Jake and Gino Show now. So, those are amazing. I generally try to focus on industry specific podcasts. So I used to listen to Biggerpockets, but it's too broad. I'll go through it. I'll pick like episodes that are more catered to me. And like, I don't care about wholesaling. I don't care about flipping. I don't care about mobile home parks. I don't care about, whatever. I want to, be learning about apartments. I would highly recommend Own Your Mind. I think that's what it's called. I don't have it here, but yeah, it's that. And the Rod Cleef podcast as well. And then there's other ones, but we don't have enough time for me to just keep rattling the podcasts that I listen to.
Yeah, I feel you there, man. No, those sound absolutely amazing. I have read the Little Purple book and a couple of the other ones there. I'm gonna have to check out the Own Your Mind one though. That sounds awesome. And I feel you on the like the Biggerpockets podcast. Like I love it. Don't get me wrong. And I used to listen to it literally every single freaking morning, right? But I mean, especially recently, like for myself, I definitely am trying to kind of niche down to the thing that I'm like just focusing on, and just try and like go heavy in that. And then, definitely love like the mindset stuff and like personal development books and that type of thing. But yeah, no, I totally feel you there. Like it doesn't really give me too much value, to be learning about like RV parks and wholesaling. And like, that's not really like my thing right now, like.
Yeah. And for those who are, boom, like dive in deep, get specialized, be very, very good at, whatever. RV parks is a new hot asset class that everybody's really liking right now. It's probably because they're actually able to finance them. If you think about the expansion of some of these asset classes and why they've grown so much recently, it usually has something to do with the availability of capital, specifically debt. So like mobile home parks used to be that you could only buy them with like 50% down. Like they would only value them based on the land costs because they figured that the trailers were all worthless. Well, then the banking standards changed for mobile home parks, and now they essentially lump them in with multifamily, which is, on a regional bank level, you can borrow at 80% leverage against a apartment complex that's stabilized. So they changed it from, 50, 60% leverage to 80 or 70% leverage, and just that made all the difference in the world. And therefore, he who bought a mobile home park back in the 90s at a 18 cap could now probably sell it at a 7 cap today, no questions asked, just because of the type of debt that you can put on the property. So, and the same thing with storage. Storage, you can put fully amortizing 30-year note SBA loans on storage. It's a beautiful thing. Beautiful.
Wow.
So
that's interesting. That's incredibly interesting. Like how that, shift has kind of happened and like, wow, that's cool stuff.
Yeah. Finding those little things and just be like, oh, that's why. That's why. Like, now it makes sense.
I see it now. I get it now.
Yeah. And the same thing with like portfolios of single family houses while the hedge funds are running around buying up houses is because they can package them all together and put on a piece of debt that's equal to what you could buy an apartment complex for. Now, that doesn't solve the issue of inefficiencies of having a scattered site portfolio and having the maintenance guy roaming around town, like going from house to 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 house, and none of the things being the same. Doesn't solve that problem, which is a very big problem. The reason why I don't do houses, it's because the efficiencies of multifamily are so much greater. You know, every kitchen is the same. Every bathroom is the same. Every square footage of all the flooring is the same. Every doorknob, there's exactly 12 doorknobs in every 2-bedroom, 2-bath apartment. So every time we go to turn an apartment and we know when the tenant's moving out, and they're moving out on Monday, guess what? On Friday, I need to make sure that on hand in stock at my office is 12 doorknobs, brand new, ready to go into that apartment. So therefore we can turn the apartment, and our average turn is about a week. So in order to get from tenant move out to move in ready unit, 1 week. If it takes longer than that, we're doing something wrong.
You know something? It's funny you say that too. So one of my buddies used to work for a REIT, doing like construction management and stuff like that. And he was telling me at an event one day, man, about like the turnaround. Like they were only allowed 5 days, and it blew my mind, right? From going like, you know, it took me like 6 months to turn over one of my units in Leominster. You know, I'm like let's talk about that. Like, how does that work? Yep. And he was telling me just like the overall system on, you know, like the commercial multifamily type of level of like, you know, like knowing when the tenant's moving out, like maybe, you know, like sending a crew in there or something before to like, you know, take an inventory of like what needs to get done, and like just doing everything in advance. So exactly like you said, like, or, you know, maybe like pre-qualifying like tenants or like a wait list or like whatever that kind of looks like, to really just have like such a small window where that thing's vacant, you know. And it just completely blew my mind. I'm like what are aspects of that are able to be applied in the residential multifamily world on a lot smaller of a scale, you know? And like, it got me thinking, like, I love the conversation, you know?
It's not applicable to residential single family house portfolios. It just doesn't work, because this house might have 14 doorknobs or a specialty thing, you know, the whatever, like you know, you have to replace the disposal because it's leaking, but you don't do it until after the tenant is moved out, because they're only moving out in a couple of days. That disposal is probably any plumbing issue we take care of ahead of time. There's other things like the fan, like we're going to replace the fan in the bedroom because it's old. Well, you know, what happens when they're out of stock of the fans that you buy at Home Depot and you're trying to turn it? Guess what? You just buy whatever fan they got on the shelf. So now what happens? Now you got 50 fans that are all different and they all look different, and you can't take like the pieces off of one and put it onto the other. You got a million different things that none of them match, and they're all mismatched, and you're having to replace it with a new one every time, and it just is not efficient in any way. We at a property that we bought a little over 12 months ago. It's 18. We bought in December of 21. We, in the first years of value add business plan, we had of the 272 units, we turned over tenants, like remodeled a unit or whatever, made it ready, and got another tenant moved in. Of 110 of those apartments, of 272, 40% of the property we turned over in 12 months.
Damn.
Guess what our vacancy rate was on average for those 12 months?
What's that?
5%.
Wow.
We turned 40% of the units in a year, and we were 5% vacant, physically vacant, for the entire year.
That's incredible.
You couldn't do that with houses or any other. No. But why? Because we knew usually at minimum 30 days, required 30 days notice if a tenant's going to move out. So then we could prepare. We could schedule our subs. We could order materials. So they're all on hand, ready to go. Boom, they go in there. They knock out the unit, turn in 5 days. And guess what? That manager knew when that unit would be move-in ready. So he would be pre-leasing the unit for move-in 10 days after the current tenant moves out. You know, give a little bit of extra leeway, right? So we have 10 days worth of vacancy in a 12-month year, or, you know, it just ends up making your vacancy rate so much lower across, you know, the entire portfolio. When you have that kind of scale and you have a couple hundred doors, as opposed to 10. If you have 10 units, you have, 2 of them are empty, you're 80% occupied, and guess what? you're not financeable.
Yeah.
You can't put an agency debt on a deal that's 80% average occupancy. So you better make sure that you never move anybody up out of their place ever, which means you have a very unlikely or hard time truly increasing the value of your asset, because you can't turn units, because you're just like, oh no, just renew them. Like, we can't afford to have it be vacant. So
yeah.
Anyways, yeah.
It's cool stuff, man. I love having that conversation, you know what I mean? Because it blew my mind, you know, like what turnover looks like on a completely different scale, you know, and like, yeah, wow.
Yeah. Game changer.
But cool, Lee. This was absolutely phenomenal, man. Oh my goodness. Where on like social media and stuff can you be found? I'll drop anything you want down below.
Yeah. So the best place to find me is Facebook. I also, so it's Lee.Fjord, Fjord. There aren't very many of them. If you literally just type in Lee Fjord, there'll be one. And then my website is greenforestcapital.com. You can go to the website and click the schedule a call with Lee button right there on the website. And I'd be happy to jump on a Zoom call with anybody who is interested in learning more about passively investing in real estate syndications. And then, I have a LinkedIn page, but that's kind of that's not my primary way of finding people. You can't just like find my phone number there, but go to the website, schedule a call. Would love to introduce you to some of the opportunities we have coming available in the near future. We're currently actively owners of properties in Missouri and Arkansas. I'm actively attacking Northwest Arkansas with a vengeance. I love the fact that like Walmart is expanding there and Tyson is expanding there. And then we also look at properties in Kansas, Oklahoma, Georgia, Florida, North Carolina, South Carolina, Tennessee, Texas, and Indiana. So we look on basically the Sun Belt and peppered in the Midwest. So where you have lots of opportunities coming our way and a great team that has a track record of success. When you combine myself and my partners, we have a couple hundred, 200 and something $1 million assets under management. I just happen to only control the Missouri and Arkansas portfolio that makes up about 40 million. And we're going to be growing to over 100 million by the end of the year.
That's beautiful, man. Extremely impressive. Guys, definitely go check out Lee. Go reach out to him. And yeah, thank you so much, man.
This was amazing. Appreciate it. Yeah.
All right, guys, that concludes our Creating Wealth podcast episode for today. I want to thank every single person that has listened this far. It really means a lot to know that people can learn from me and with me as we build wealth together. Hopefully, you can take home at least one thing from this podcast that will improve your life just a little bit. If you could, please check me out on social. That's at Kyle Curtin Real Estate on Instagram, Facebook, and I'm on Biggerpockets. Until next time, let's build together.